Hey everybody, welcome to Retire with Style. I'm Alex and I'm here with,
Bob?
And Brian.
and I guess next time I should be more explicit before we start saying who will talk first. Who wants to greet themselves first?
It's a well-oiled machine here.
Yeah,
So,
exactly. Off the cuff. But this is the second episode in a row that we're having. We had Brian and Bob on the last one. So if you want to know a little bit more about their Avengers origin story, check out the last episode. Although Bob, we've had previous to that as well. And we wanted to create these episodes simply because, there's during the course of a year, there's roughly 6 inflection points that give investors pause for concern, if you will. And so it's always good to stay out in front of it. As I said previously, Wade couldn't make it today as of this recording. It was an impromptu session because we wanted to really get out there. But Wade and I we'll be back next week. But for now, we got good information with Brian and Bob, and it's a continuation of the last episode, which was about what are the client conversations looking like right now in light of what's happening. Since at this point, to borrow Bob's phrase, we've gotten a good slug of client meetings already, since the start of this downturn. So, I don't know, I thought it'd be great to just listen in. Brian, you want to take it away?
Yeah, sure. So I guess to kind of structure this, there's really been three types of people as we've really kind of had all these conversations across, all of our clients, and it really has become obvious that there are people in the right places. There are some people that were in the wrong strategies for their retirement income. So I thought it might be helpful just to kind of lay out, what these people look like and kind of the where they fall on the risk spectrum of retirement income. Obviously
To be clear, Brian, on the risk spectrum or on the RISO profile?
Kind of one and the same, I guess. So the
Okay,
risk spectrum. So as far as how much risk we're taking in the retirement income plan, right? So
got
obviously
it.
on the far left side of the continuum is your, full on protected income. We're going to annuitize all of it. There's no risk. On the far other side of the spectrum is your total return people that have no protections. It's kind of pedal to the metal. We're going to take some upside. We're going to take some downside, and we understand the risks around that, and we're okay with those risks.
Sure. And
Um,
then the up or down is the optionality component.
The optionality. So we have some people that are in the time segmentation especially is a really cool place to be. There's a lot of different ways to do that, but there's also a flooring approach where we have a floor and then we have the total return on top of that. So we kind of create a cool hybrid with an
Yeah, yeah.
overlay of however much risk we want to take on. Um, but I guess just starting at the total return, folks, that's a majority of the people, not a majority. I guess your numbers were I think 35% of the people fall into total
Yeah, they're
return.
split pretty evenly between
Yeah,
income
income
protection
protection.
and total return.
Right. So the total return people, this is really kind of a gut check moment for them. This is really, we've had, 2000, 2008. So some of the people lived through that, but most of them were in the accumulation phase at that point. So it was really almost, uh, an uncomfortable buying opportunity at that point for them. But now as they've gotten either close to retirement or are in retirement, um, really getting into the conversations of is this right for me? Can I sustain this over the long haul for my retirement? Is this something that I want to continue to do? So you're looking at your 60, 65-year-old people that typically one of our client relationships is a man and a woman that had been super successful each in their own right over the years, and both were very high earners. Both were at really really good savings rates, put away a ton of money, and so now they're in retirement, and they're both kind of running into a scenario where they're creating a paycheck, from a set, a set asset allocation, which is very foreign for a lot of people. We go from human capital to, financial capital, and a lot of times it's a rude awakening as far as how does that work and how does that actually look for us. And so as we get into those conversations where, are we doing the right thing? Did we do this right? We really kind of tee it back up to, well, let's go back to the RISA. Let's use the RISA and figure out, what you really feel now. Because to Bob's point in the last episode, times change and our emotions change and our views on things change. So, something that we may have set up 10 years ago or 5 years ago may not be right anymore.
But let
Um,
me add to that, Brian. In terms of before, admittedly, at McLean Asset Management, and that's where Brian is a lead advisor at, up until we really started doing this research, Wade and I, we were essentially a total return firm, the traditional total return firm, and we do planning. But that was the hammer and the nail kind of thing. And whenever anyone expressed any interest in an annuity or something structured, we kind of didn't pay as much attention to it as we should have. Guilty as charged. That's not good or bad. It's just how it was. And so, frankly, those folks maybe didn't even become clients. They were prospects. Or we would just refer it out to somebody, an insurance person that can help out. We get everything ready and refer it out. And so as we got started in this research, it actually made us think, how do we want to run the firm in which, has the practical application of all this research? And so about a year and a half ago, we really started doing everything in-house. And so some of those clients that we've had clients for 20 plus years. And so some of those clients that have been 20 plus years, 10 plus years, there is a calibration to be had. I wouldn't say they change how they were 10 years ago, 20 years ago. It was really more we weren't as in tune as we should have been in terms of picking up their styles. Because the RISA, that's where your retirement income style awareness profile will identify how you want to source retirement income, and it maps to a strategy. That's pretty consistent we've seen in the research. What's not consistent are risk tolerance questionnaires.
True.
Like how well you can sleep at night, with an aggressive portfolio versus a conservative portfolio, that kind of stuff. And those are those three questions that put you in some sort of model portfolio that always assume a total return approach. That I do have issues with because they are transient. Since we're not going to apply it to inflation anymore, I'll apply it to risk tolerance. That's more transient, and so those should be revisited because at the end of the day, there's a role for investments in everything, and so you should be in tune to it. Sorry, Brian, I wanted to just lay the groundwork a little bit.
Yeah, but to your point also, when you're in accumulation and markets are down 20 or 30%, you tend not to care as much simply because you don't
Not fun, but
you don't need the money. You're 20 whatever years away from retirement, so it's not that big a deal. But it's a very different scenario when you're in retirement. This is the only money I'm going to have for the rest of my life.
Great.
It creates a different set of emotions. So I might push back a little bit on the people don't change. I think as the situations change and as they do get into retirement, I do believe that emotions can change, and these people now are having a different conversation around, what does risk really mean to me at this point?
Yeah, and to be more specific, I'm referring to the way they want to source retirement income.
Sure.
Seems very steady, seems more trait-like. And, those people are going to be people that maybe if they're working for the government getting a pension right now.
Right.
They're kind of doing that right now. So,
yeah, the other thing is good market returns cover up a lot of sins. When the market's going up, everyone's real happy. It's only when the market starts coming down, people start getting a little worried.
Okay,
Absolutely.
And so take us through some of those conversations, Brian. I'd like to get out of this the ability for our listeners to kind of paint themselves in kind of like the situations you're presenting, because in a way they can then sort of, this is a sounding board episode for them, which
Sure.
would add good value.
And a lot of times that's how we start conversations with new clients and people who are coming to us from other firms is they come to us with a portfolio of stocks and bonds or the hottest mutual funds or whatever their quote unquote advisor was doing at the time, and it is total return. And people have not really been maybe educated as much as they should have been on what that entails and what that looks like in a spend down scenario. And so what we really try to do is lay out the options. What does it mean if this goes wrong? Like what are the levers that we have to start to pull if markets don't cooperate and they don't do the things that we expect them to do? And that's obviously the first one that we go to is probably gonna have to spend less money. Is that something that you're comfortable with doing? Is there even in the realm of conversations between you and your spouse, is there an option to say, hey, we're going to spend $20,000 less this year, or 30 or 40 or $50,000 less this year because markets are bad? And if the answer there is no, that's crazy, I can never do that, then we need to start talking about how do we get out of this total return and get into something that's more palatable that can create a more a smoother ride as we start to generate your income. Because total return is ultimately the downside risk there is you do have to make some concessions on how much money you're going to spend sometimes. So
There's that. There's 2 points. One is more FYI, and Wade brought this to my attention, and so did a gentleman by the name of David Lau, who's well known within the industry.
Sure.
Bengen, who created the 4% rule, who whatever. That implies that you're going to take 4% the initial year, and then now that you have that nominal amount, you adjust it for inflation going forward. And I forgot the exact number, but something like he would say, don't deviate below. While he was creating this, you don't want to deviate below. I'm going to make it up, but I'm not too far off. 50% equity allocation. You want to keep it at least that much or higher.
Right.
Article came out in the New York Times, I want to say 3-4 weeks ago, where he himself is applying this, but he was hesitant of the market. He effectively contracts with a market timing strategist, and he's now at 20% equities. It's kind of like the irony is the person that created the 4% rule can't really follow it, and so to some extent, this I think goes to your point about how everyone has a plan, right? But when you get hit, it's different.
That's exactly right. And it is. You don't know. To Bob's point, you don't know how you're going to react until things go wrong. I mean, in a raging bull market, the returns eliminate, as you said, a lot of sins. So there's no real urgency when everything is going up. Stocks are up, bonds are up, cash is up. Everything is going in the same direction. It's easy. Like anyone can do this job is in a bull market, right? It's times like this when we're down 20, when bonds are down 10, 15. Now is when you really figure out, was this right for me? And those are the conversations we need to be having, 18 months ago when markets are up. That's the time when we figure out what is your retirement income style, how do we source this income, and let's talk about what this is really going to feel like at 30% down. Are you going to be okay with this? And a lot of the people that have bitten off the total return and continue to go down that road understand it and are okay. Either we've built in a buffer into their savings goals, spending goals, whatever, and they're okay with this. So that's okay, and it's not a bad place to be if you're okay with having volatile spending.
Yeah, and do you find there's two types of people that this could be okay with or not okay with it? I think it could go either way. And I'm going to borrow a theme from one of the guy's very credible. His name is Brian Portnoy, not to be confused with the meme Portnoy guy. This is another gentleman, and he's come up with and he's come up with the term funded contentment, and I love that term. I mean, what it effectively is, and this goes to your point, I think, about total return. Where's that balance, right? Of how much risk, how much not risk to take. I don't even know if I said that correctly, but there's that balance. And funded contentment implies that, as it stands, with what you want to do with your life, you're in good shape. You're content. You're funded to be in good shape. And he uses that to make this separation between what's wealthy and a rich mindset. A wealth mindset sort of contextualizes everything, and comes at it with, listen, I'm funded contently. I'm good. Regardless if the market drops 10%, whatever, I'm good. Yes, we do the Monte Carlo, but even if the Monte Carlo percent of success drops from making it up 95% to 85%, which is still healthy in my opinion, but let's just say that they're not of that opinion, well, you do have a magnitude of failure. And a magnitude of failure is, if you run a Monte Carlo, you do 1,000 scenarios, like Bob said, and one of them is short by $1 by the time of death. That's a failure. And so realistically, no one really cares about that. And so I think figuring out where they are on this funded contentment scale and mixing that in with this magnitude of failure score, which I like better than the Monte Carlo itself. I think I put it up to you, since I really haven't seen clients in 10 plus years at this point. But I think it's something that, I'd look to hear about what those conversations look like with that specific dynamic.
Yeah, that's part of every conversation we have. So we show our retirement plan, and at the very bottom, once we get through the success rate, we'll show the shortfall analysis. And what we'll do is we'll look at that exact point. So if we're running our plan out to age 100, and the shortfall analysis says, the median shortfall was $8,000 at age 99, that, yes, the plans did ultimately quote unquote fail, but they were by $8,000 at age 99, right? So we were 1 year away from our total goal, and we only failed at by a very small number, assuming that all things
Yeah.
were equal and the spend goal was much higher than that, right? So that's a great point is we can start to try to mitigate the downside of these plans by using things like annuities to guarantee lifetime income in these things. So it's been amazing. You show a total return person a plan that includes an annuity, whatever size, however big you want to go with it, and the downfall goes from say age 80 to age 82. I just bought you 2 more years and got you 2 years closer to your forecasted age of death, right? So whatever year we're quoting.
So you're like the Grim Reaper?
Right, I am the Grim Reaper. I'm going to tell you exactly when you're going to and exactly how much money you're going to have.
Wow, where do I sign up?
No, but to your point, I mean, as the Monte Carlo, like you said, is you're $1 short and that's a failure. So it's not a precise instrument. It's not a something that it's not a crystal ball that's going to show you is this going to work, is it not going to work. The more important analysis is that shortfall of what does adding guaranteed income do to this plan, and what does it do to the smoothness of your spending, if you will. Like maybe we don't have to take those massive cuts to our discretionary spending every year because we have a larger slug of guaranteed income.
Makes perfect sense. And do you always need to show clients the numbers right now? Because it's such an emotional trigger. The last 2 months have been, not within normal limits, to some extent. And so is it a matter of running numbers, or can you just sort of allay their concerns by just speaking to them about certain topics?
The numbers we try to avoid a little bit. We're going to show them. We're going to tell you, hey, look, this is the real picture. But ultimately, if we can tie that back to their retirement income, that's what people care about is can I live the retirement that in my head I'm envisioning going forward? Like I know I want to do X, Y, and Z. Can I still do those things and be okay? That's where we try to take the conversation of, look, your income plan is still solid. Yes, your overall performance sucks right now. The markets are getting, they're doing their thing. Like they're not good. It's not great. But ultimately, listen, here's our plan. Here's where we are looking for from day one. And you're going to be okay by doing, these are the things that you told me you wanted to do. Here are the numbers that we have in the portfolio, and everything's going to be okay within a range of outcomes. And, let's take a step back again. Let's take a deep breath, look at what's important. Where are the levers that we need to pull that, worst comes to worst, what are we going to cut out of this? And a lot of times it's stuff that they're okay cutting out of.
Bob?
Yeah, no, and I think an interesting part of this conversation is, there are definitely those people who are okay with that total return approach and everything that it implies. And we've kind of danced around the subject a little bit, but there's a lot of people for whatever reason, very legitimately, they've been, saving for retirement, and everyone kind of has the same very underlying basic approach during the accumulation phase, which is just throw money at your portfolio, at the asset allocation you're comfortable with. But as we get towards retirement, we do start paying more attention to retirement income style. So, in a situation like this, when you start talking to someone who maybe is in a portfolio that looks like is a total return style portfolio, but they're not quite on that total return side of things. They're either time segmentation or income protection or whatever else they might be. What do those conversations look like?
So as we transition away from that total return, I mean, it really becomes, when people want to get away from total return, it really becomes downside mitigation. Like, how are we going to reduce the risks of this portfolio to still, achieve our goals and get us down the road where we need to go? So from there, if we're going to go to something like a time segmentation, a lot of times we don't end up going from total return all the way to income protection just because that's a hugely drastic shift.
Real quick. This is the time segmentation. What that effectively implies is almost is a bucketing approach.
Yep.
You're matching near-term expenses with protected contractual income, be it cash, CDs, individual bonds, MIGAs, so that's time segmentation, and then you're going to replenish those buckets because the market is going to, potentially, the expectation is the market will be able to grow and you'll be able to take money from the markets and put it in new buckets as they're depleted. That's a time segmentation approach, a bucketing approach.
That's
Sorry,
exactly
Brian, I
right.
just wanted to throw that in
Yeah.
there.
No, that's great. That's a great segue into what time segmentation is and how it works. I mean, ultimately, what you're trying to do there is avoid the sequence risk. You're avoiding the really bad run of returns right around retirement. So, I mean, the math says that the 5 years before and the 5 years after, the most crucial parts of the retirement sequence in relation to the markets, right? So if we get bad market returns during those 10 years, the outcomes are not as great as they would have been had we had normal or positive market returns. So when we talk about taking money from a total return approach and moving it into a bucketing approach, the idea there is we have years worth of income set aside so we don't have to touch the portfolio when markets are down, right? So ultimately in decumulation, the more we spend down in a down market, the less capital we have to rebound. So if we have other assets, even buffer assets, so if we had a long-term whole life policy with cash value in it that we've had for 20, 30 years, we can tap that instead of touching our portfolio. So there's a whole bunch of really cool ways to kind of design time segmentation. It doesn't necessarily have to be, hey, we have 3 bonds that are representative of 3 years of cash flow. There's a million ways to create that hybrid approach to the bucketing. But ultimately, you're right. The idea there is we know where our cash is. We know where our spending is going to come from. We know we have this volatile portfolio on the side that ultimately is going to drive it. But if we can leave it alone in times like now and use our other sources of cash, then we're probably going to be okay with that portfolio.
I agree. The couple of caveats. Mathematically, a time segmentation strategy is probably the least superior
Yep.
to all the others, but it serves a great mental accounting kind of purpose. It really feeds into the psychology of nerves, and that's ultimately what's important. So that's where that is. And Bob, what was I going to say in terms of the time segmentation? What are your thoughts around that one?
Yeah, I mean, I think it's actually really interesting in that you're absolutely right. From just a straight math perspective, time segmentation is the least efficient way to generate retirement income. But the thing is, that doesn't matter, because if that's the way that you're going to be able to stay disciplined, that's how you should do it. Total return is the most efficient way, on average over the long term. But if you can't stay disciplined for that long term, if that's something that makes you wildly uncomfortable, then it's going to end up being the least efficient way.
I don't agree with, and it's okay. Bob and I and Brian and Wade, we're always coming at each other. So we're still friends, everybody. I don't agree with the assumption that total return is the most efficient. Whatever efficient means, because you didn't define it.
It has the highest upside. It has the highest average expected value.
If you think of it in terms of retirement income, you can make a strong case that if you have a floor of annuities to represent some portion of the bonds within a portfolio, it's actually a more optimal way to do it from a pure numbers perspective. But Wade's not here, so I'll let him kick you around later.
I'm the investing guy. I got my biases going here.
Yeah. No, exactly. we're all like that. But just FYI, I mean, first, just what does efficient mean? But the larger question, you're right. The larger point that you're making is correct. So, I just like to.
Just wanted to make sure everyone knew you thought I was wrong.
Exactly.
So.
Pretty much.
But I think it goes back to the goals. Like, what is the goal? If the goal is to have the highest portfolio value when I'm dead, that's great.
Yeah.
Total return is absolutely the way to go.
Yeah,
let's add as much
yeah.
equity to this thing as possible, and let's let it run. Right. So if the goal is to create a comfortable retirement that meets the spending goals, that gets me into my lifestyle that I want to lead in retirement, then let's figure out how to do that by taking on the least amount of risk possible.
100%. And I'll say this: it came up. We had a podcast with Michael Finke previously, and I think he brought it up, and he's right. We're not trying to be, with all these other strategies beyond total return, no one is trying to sort of jam somebody in something that's suboptimal. The reality is that if you're in a total return, you're most likely going to hold back on what you can spend during retirement, because there's always this overhang. There's always this just-in-case overhang that you can't kick. You really can't. Whereas If you're in income protection, which income protection is you get on the floor, you get an income floor for the entirety of your retirement, be it an annuity that you purchased, being a pension that you happen to work at the World Bank or something like that, or Social Security that's covering a significant amount of your overall wealth, right? And so to the degree that you're exposed to that, you're able to actually spend, proportionally speaking, more in retirement because you have that security. And I think Brian, you see this a lot with our clients that are in total return. They some of the conversations you're having with them is not, hey, you have to spend down. It's you should spend more because you're okay on many levels. And so as advisors, I think sometimes it's framed as what you can't do, to the client. The reality is we spend as much, if not more time trying to get them to spend these assets because they're there. A total return kind of runs a little counter to that because of that apprehension of the just in case. Brian, did I get it right? Did I get it wrong? In between?
That's 100% right. We have several clients we've had multiple conversations like, listen, you have the capacity to spend another $200,000, $300,000, $400,000 a year and be perfectly fine. But to your point, they are terrified of the thought of ramping up their lifestyle and then having it go wrong. The lifestyle creep is real, right? So once that genie gets out of the bottle, it's very hard to put it back in. And people in a total return that don't have a lot of guaranteed income are very apprehensive about doing that. And it turns into, what kind of lifestyle, and again, some people, they're very happy with their lifestyle and they don't care about spending another whatever X dollars a year. That doesn't matter to them. But there are several instances, and recently we've had these very conversations of, what are we doing? There's no, the one that pops into my head, that they don't have children. There's no real legacy goal in place. And, we're forecasting them to have, multiple tens of millions of dollars at the end. At that point,
you can say Bob's name. It's not a problem.
But to your point, it really is. It's figuring out what lifestyle do you want to lead in retirement, and is it going to work? I mean, ultimately, that's all that matters in this equation. It's not a math problem anymore. It's how do we live our lives? How do we put this together so that you can live the life you want and put your head on the pillow and not have to worry about any of this stuff at the end of the day?
Yeah, it kind of goes to that funded contentment.
Yeah.
Phrase.
Yeah. Yeah, and actually, I think it is worth calling out that, if you have not done the reset and kind of looked at where you fall on this, we're going to have a retirement income challenge on the retirement researcher side of the fence relatively shortly in the next few months. And that's a really, really great way of kind of diving into some of these questions and starting to figure out, how you might actually want to be able to do that. So you'll be doing the RISA, obviously. You'll also be doing a funded ratio plan. And really kind of thinking through a lot of exactly what it is that we're talking about here, what you want your retirement to look like and how you feel comfortable funding that. So I think we'll put something in the show notes for if you're interested in signing up for that.
Yeah, retirementresearcher.com. Go there and we'll have something. There's a pop-up to be on the waiting list, I believe. I'm not sure. Or is this one of these times, Bob, where I spoke up without confirming?
Well, it will be when we launch this podcast.
It's good. The other piece, Brian, is how often it seems to me from listening to this, because before these episodes, I thought it'd be great that we could talk about the markets and the conversations about the markets that you're actually having with clients. I'm getting the sense from from these last two episodes that we really don't talk about the markets all that much when client meetings come in. Is that a true assessment on my part, or no? You just haven't mentioned it.
No, I mean there are a small subset of clients that do enjoy getting into the weeds of markets and really popping the hood on different equity indices and kind of getting into the weeds there. Those are conversations we definitely have, but for the most part, people just want to know that they have the right portfolio, they have the right engine in their car, and that's going to get them to their end point. I mean, a lot of our clients, it's been beaten into them over the years. Don't look at the markets. Don't look at the markets. Even in 2021 when things were amazing.
Now he means beaten in the nicest of ways.
Of course, yeah. massaged into the conversation.
More like osmosis. No, no.
Right.
Yeah.
But even, I mean, you look at 2021, people had monster years in their portfolios, and at the end of the day, I mean, at the end of Q4 last year, when we were having our client meetings for year-end planning stuff, a lot of them were like, this was really fun, but we know this isn't real. Like, it's not going to continue this. We know this isn't an average return, a normal return, and they already kind of knew like something bad's going to happen at some point. It's really
Well, I mean,
it is. It's
Yep.
if you
don't.
lean on your financial plan, it really is. It's all that matters is, do I have the right engine to get me where I need to go?
No, that's great. Actually, that's a great analogy. I think you're right, 100%. I mean, I start thinking myself at macro level, right? I'm not, I'm not the client, I'm not the advisor. But if I just look at it, the last real downturn we had was in '08.
Mm-hmm.
I mean, we're due. I mean, you get these bear markets once every, I don't know, 4 or 5 years, right? I'm not saying we're due tomorrow, but you can see it happening, right? It's, eventually it's going to hit. I think Bob is looking at me like, don't forecast this and that, but the hell with him. No, I mean, it's healthy. It's healthy to have these drawdowns because it brings risk back into the equation.
Yes, absolutely. I mean, we've had one of the longest bull markets in market history. Markets go up and down, and frankly, I mean, to a certain extent, you're absolutely right. People have, intellectually, I don't think people have forgotten that markets go up and down. We have enough bad weeks, months, quarters. We've had a couple bad years. But emotionally, I think people have gotten used to it over the past, call it 10, 15-ish years. Markets go up and, they're safe to some degree. That's not true. They go up and they go down, and they can go down a lot. And it's really important to keep that in mind. They're really, really great tools. And they're tools with a place in I think most people's retirement income plans, but you got to be careful with how you use them. They're power tools. They can do great things, but they can also chop off your foot pretty quick.
Great visual. Thank you.
There you go.
Did you see the movie Saw or something?
No, I'm thinking back to one of my actual investment courses we did a while back. I had this great image of a guy, it looks like at a county fair, using a chainsaw barefoot, like doing some like chainsaw carving, like 3 inches from his foot. And that was one of the images I used for deciding on your asset allocation.
Yeah, that's not a
great tool, but watch yourself.
Yeah. So, Brian, what has been your favorite and least favorite conversations that you've had this year? Except for this current one.
Obviously.
Clearly, this is the favorite one.
This is the apex. No, but in terms of client conversations, what I don't know, which one comes to mind that, this is a good one? Or, hey, look, this is not a good fit.
I think my favorite ones have been a couple recently that really dove into the I bonds, right? I mean, it was I'm selling out of equities, I have to buy I bonds, like the world is going to end, this is kind of my thing. And so our conversations around that were, hey, let's explain what these I bonds actually do, how the interest rate component on those things work, and really show them kind of the break even of how those things are projecting, assuming the markets are correct in their pricing, what the interest is actually going to do over the next 3 to 5 years, and then bring that back into their risk tolerance and their financial plan of, equities for the long haul, right? I mean, that's historically been the driver of returns is the equities, right? So getting that message across and having people buy into those ideas and really take a step back and look at why we're investing in the first place, and then listening to the advice. Those are the best conversations. Just again, it all goes back to the financial plan. You take on a whole bunch more bonds, and now all of a sudden the overall asset allocation comes down, and now we're in a different spot than we were before. Something
that we did on our in-stream days, I agree with you. It's almost like your benchmark is not the S&P. Your benchmark is your personal situation.
Right.
And when we created Instream, we actually trademarked the results to be called personal benchmark analysis, because that's what we're trying to drive home. Now, we say this, and these are all nice things to say, but not everyone can agree. I'm sure you have some people that are like, "Hey, this is a bunch of BS. You're just trying to distract me from the fact that you're not a very good advisor from an investment standpoint." Well, no, honest question. Because we're doing nothing. The market has dropped, and here we are. The best thing you're telling me is to rebalance. What would you say to that?
I mean, there are people that will have multiple advisors in place and have, money at different shops and are very actively comparing returns. I mean, ultimately, it's we build a very specific asset allocation for individual investors, and it's may or may not look like anything else that's out there. So it really is just going back to, here's why we did what we did in the first place. This is why we built it. This is how we built it, and this is the results that we need to drive your financial plan forward. So you're always going to get into a pissing match with returns, right? There's always someone that's going to tout higher returns or better this, or whatever the case may be. That's how salespeople do their work, right? I mean, there's always going to be that. So ultimately, if you're with us and you're using us for our advice, listen to the advice, because it's coming from a place where we listen to you. We know exactly what you want, where you're going, where the things that we need to put in place to get there, and those are the things that we're going to deliver for you.
Yeah, and there's two types of clients. There's the delegators, which are folks that kind of really outsource all that to you because they're just interested in what time it is, right?
Sure.
They want to enjoy their retirement fully. They don't like the numbers or whatnot. And those are good relationships as long as they're involved, because those are the ones that every 2 years, you can barely get them in for a meeting, but when you do, it could be 2-year intervals, and they just look real quick at a statement and say, what the hell am I doing? Kind of thing. So there's a double-edged sword there. Collaborators is kind of what I think you're talking about, where you're working actively with the client. You're the financial planning lead, but they're the ones that are kind of the general manager or whatnot. They're the ones that, kind of want to chime in with their ideas and the like, which is great, because then it's a nice back and forth. Especially for us, we're kind of like data nerds, so we love talking about that. But even for those folks that are these collaborators that really want to get involved in co-leading the plan, it's a team approach, etc. How much of that is what the problem there is wisdom, not knowledge, right? Where you have a sample size of 500 individuals you can draw from within the firm, whereas they're just a sample size of one.
Correct.
Right? And so they don't have the wisdom of realizing, yeah, I read that in a book, but they come up to you with something that they read in a book, but sometimes the answer is, yeah, but that's just one way to do it. There's a million others. Because of what we know about your situation, we want to tilt this way instead because that's what we've seen. Does that make sense, what I've just said?
No, that's exactly right. And a lot of the problem is when you read something, you're looking at one individual problem in a silo, and you don't realize that maybe that problem, solving it the way that you think you need to solve it, is going to affect 3 other parts of the financial plan negatively. And so our goal is to say, look, we don't ever make any decision in a silo. We're gonna plug everything back into the plan. Anything the collaborators very much always have different ideas and come to you with different things. And I want to do this or I want to do that. How does that affect me in the plan? And that's great. Sometimes the things work and sometimes they don't necessarily work. But ultimately, we're gonna show them. I don't want to say mathematically, but we're gonna show them the reasoning behind why it works or why it doesn't work. And ultimately, it's kind of them leaning on us to make sure that we're doing the right thing across the entire picture.
I got you. Yeah, so I think what I'm hearing, because at the start of these, we thought, hey, it'd be great to have these client conversations. Mm-hmm. What are they about? It seems to me, in spite of what's happening in the markets, the Ukraine, the supply shocks, this administration versus that administration sort of comments, the Fed, inflation, et cetera, clients kind of want us to know that we know what's going on in terms of just current events kind of thing. But I don't get the sense that, yes, there are some in the fringes, but I don't get the sense people are trying to recalibrate the entirety of their plan because of what's happening now. It seems they've gotten the joke, for lack of a better word, and they've realized that listen, at the end of the day, it's context that matters, and let's make sure that context still applies.
That's exactly right. I mean, the people that really want to take deep dives into inflation or the politics, they just want to know that we're, like, I mean, to your point exactly, they just want to know that we know what we're doing, right? It's not that, we have the best answer of how inflation is going to affect market pricing in the next 3 days. We don't have a crystal ball. Nobody has a crystal ball, right? It's just we're paying attention. We know what's going on. We have an idea of why things are happening in the portfolios and what the kind of macro events are going on that are affecting things. And then ultimately, are we going to be okay through this? Can we make it through this? Is this going to be the end of us? Or are we going to be okay? That's the big question at the end of the day. Are we going to be okay?
Yeah, you're right, because we can get into this, and Bob, correct me if I'm wrong, but okay, you're having a conversation with a client on inflation and the market's dropping, and the easy answer is, well, the markets are dropping because the change in the risk-free rate causes everyone's valuation model to correct. And when it's unexpected inflation, they tend to recalibrate pretty quickly. Hence, you saw what we had this week and last week.
Yep.
That's the answer. Now, Bob, I don't want to, I said it in a...
No, that's absolutely right. I mean, the markets react very fast to this stuff. And one of the things to keep in mind, and I actually wrote an article last time the Fed was raising rates a few years back, looking at how changes in the federal funds rates affect the markets. And outside of really short-term periods, a couple days, not by a huge amount. You don't see a big impact one way or the other when the Fed raises or lowers interest rates. And it's also important to keep in mind, we often talk about how markets move based on how events square with market expectations. Well, market expectations, we often talk about them as kind of, hey, this is what the market thinks will happen. It's really more of, hey, here's the weighted average of everything that the market thinks will happen. It looks at things probabilistically. It's, hey, there's this chance that the Fed will raise rates by this amount. There's this chance that it'll raise by that amount, or whatever is relevant. It's a very kind of, it's a cloud of probability, if you will. And as we collapse and something specific happens, the market will adjust for that. And, as Alex said, it does it very quickly.
And you can't stay ahead of that because these events happen randomly.
Yeah, exactly.
It's lucky.
It's what happens next. And how that squares with that probabilistic guess that the market's making. And, we don't have that crystal ball, as Brian said.
And Brian, how do you deal with a client or a prospect that comes in and says, hey, look, I know, inflation is not going to stop until it's 3 more years. And so I want to do such and such for 3 years. I get the whole plan context or whatever, but you know what? I need to change things up because I'm looking at 3-year inflation. I can just feel it in my bones, if you will.
Sure.
What do you say? Because it's a balance between, the answer is no, you're wrong, that kind of thing, or the answer is, well, how do you address that?
So my response is typically, if you know something that the thousands and thousands of analysts and market participants don't know, then, good for you. If it's kind of one of those deals where, if you feel like you're smarter than the market and, again, there's thousands of eyeballs on every single piece of data that comes out and every company report and all the things that are going on in the markets and the computers, if you can beat them on their, how fast they're trading and how fast everything is moving, then place your bets. But ultimately, that's what you're doing. You're putting money on a roulette table. You're picking a number or a color, and you're spinning the wheel. That's historically, typically, why active management doesn't always work. Is because people are ultimately trying to outthink markets and outguess markets, and sometimes you win and sometimes you lose. But more times than not, that's why casinos have the big fancy buildings.
And this applies to inflation because inflation affects pricing. Now, what is the reaction that you get from folks when you say something like that?
Sometimes it's positive, sometimes it's not so positive. It's
fine. No. I find it fascinating. That's why I'm asking.
Yeah, no, it's never fun or easy to be told you're wrong, and you try to make that as ginger a conversation as possible, and you tread lightly, and you're obviously not trying to make anyone feel dumb or stupid or anything like that. But ultimately, our view is the market pricing is the collection of thousands of great minds, and the only way you can really beat that is if you know something that everyone else doesn't know.
Yeah.
So,
And going back to this, just to make sure people don't think we're being severe, when Brian said you're wrong, as that's what we tell clients, it's not that we know we're right, but we have a framework in which we make our decisions on, and it doesn't reconcile. And it is what it is from that vantage point.
sure. I mean, if you believe in efficient markets and fair market participation, then the balance of a stock price or a bond price or whatever is the combination of all the sellers and all the buyers, and kind of where that equilibrium lands is the price of the asset. So, again, do you know something that everyone else doesn't know, or are we just making bets?
Yeah. What about Pelosi's husband? No, I'm just kidding. Look at Bob. Bob,
We're not touching that one, Alex.
Bob went out of the screen for a little bit. Well, or the senator from Georgia there. That way we pick Democrat and a Republican. There was. All right. Look. All right. Anything else you want to add to this? We're 45 minutes in.
No, I think a good way of kind of summing this up is it really will come down to, making sure that your retirement income plan actually is aligned with how you should be building that plan, making sure that it's aligned with your retirement income style. And that, that's never a panacea. Even if you are a total return person and you're in a total return portfolio, you're still going to be nervous, and that's okay. But it's really trying to align these things with how you approach the world and how you approach your retirement income plan, and your retirement income. So, if you get that solves at least a good chunk of the problem, not all of it, but a good chunk. And then you can work from there and really being focused on that long-term plan.
Okay, I think that's wise. All right, I think that's all we have. Thank you, everyone, for listening to today's podcast. We'll have show notes with lots of links for McLean, for Retirement Researcher. Did we mention in this episode the Retirement Income Challenge?
We did. I'll call it out again since you brought it up. But if you do want to take part, the Retirement Income Challenge is, a pretty intensive 4-day challenge, walking you through taking the reset, taking the funded ratio, and really kind of putting you in the place where you're coming out of that with a reasonably solid idea of how you should be approaching your retirement, what your retirement plan should look like, and giving you the tools to really kind of dive in on that. It's a lot of fun, but a good amount of work, but you come out of it with a lot of really, really good information.
And we'll have a show notes link to that so you can sign up. You can be on the waiting list. And this gets to what Brian was saying at the very beginning. It all depends on the context. If you get the context of why you're investing, everything kind of falls into place afterwards. All right. Thank you so much, Brian, for chipping in here during this week. No, of course. And Bob, who invited you, Bob? No.
I just show up every once in a while.
No. And Bob, thanks, man. I really appreciate you helping us out. All right.
Okay.
Bye, everyone.
Bye, everyone.